Hey, it's Andrew Roach with the Roach Family Real Estate Team. So you probably read my little article before this video about how Lisa and I have purchased our first investment property on our own, and how we've gained about over 83% return on investment. I wanted to get into that a little bit and explain kind of how that has happened. In this video here, I'm going to go really high level and I'm going to explain how in real estate you actually have multiple streams of income. Contrary to other types of investments, which I'm not saying that one is better than the other, so don't take this the wrong way. But if you're investing in gold as an example, really it's just, does the gold go up in value? Does it not go up in value? That would be appreciation. If you're investing in a stock, same idea. Does the value of the stock go up or down? Some stocks have the benefit of having a dividend attached to it. So you've got two streams of income there essentially. If the stock value goes up in value and is paying you a dividend, you've got multiple streams of income there as well. In real estate, we're actually blessed with actually having 4 streams of income, and I'm going to go into that in a second here. So the first one that probably people are most aware of is, well, actually I don't know which one. One of them that the people are most aware of, I would say, is appreciation, right? Similar, sorry, I'm a terrible speller and it takes me a second to figure out how to spell stuff. The number one thing that people think of often is, I want to buy an investment property, it's going to go up in value. You're probably most familiar with that because you may or may not own your own house right now, and I would probably assume that it's probably worth more now than it was when you bought it. That's appreciation, obviously, right? The second one that obviously people are most familiar with would be cash flow. And I would actually say positive cash flow, right? And what is positive cash flow? Let's go into that for a second. Let's say that we own a house, right? And it rents for $1,500 a month. And I'm going to make numbers here really easy. They may or may not be practical or be the way that it would work in the market that you're going to invest in, or the Milton market, or whatever market. But we'll just use this for example, right? So let's just say that in this house you're able to rent it for $1,500 a month. The mortgage on it is $1,000 a month. Taxes on it are $200 a month, and insurance is $100 a month. Okay, so that's $1,300 a month. We started with 15, so that leaves us $200 a month in positive cash flow, right? So that's a stream of income. Every month we're going to collect $200. It's going to go into our pocket because we made $1,500 on it. We paid $1,300, and we're left with $200. So that's our income stream, right? That's one of our income streams in cash flow. Another one that people often overlook or don't really think about is mortgage pay down. And let's think about that for a second. So every month we know, just like your house, mortgage payment comes out. You've got a loan, right? So every month a mortgage payment goes down. But don't forget that every month you're collecting $1,500, right? So in this example here, every month you're collecting $1,500. Okay, you're making $200 a month. $1,000 mortgage payment is coming out, and again, let's just keep things nice and simple, and let's just assume that that you're paying. You took a long mortgage. Keeping numbers really simple. That from that mortgage payment, $500 is interest, and $500 is paying down the balance of your mortgage. So in that situation, now we've got 2 streams of income. We've got our $200, we've got our $500. So now we're sitting at essentially $700 a month in mortgage pay down. The fourth one, which most people aren't familiar with, is a tax benefit that you actually get by owning an investment property. And the way that works is that the value of the property is in the land, right? The improvement on the property is the house, right? Whether it's a single family house, a duplex, a triplex, whatever the case may be. That takes maintenance to upkeep, right? So so every year, you know, you're going to have to do some amount of upkeep. It's going to need a new roof every 15 to 30 years, whatever the case may be. You know, it's going to need paint, all that kind of stuff, right? So the value of the actual structure is actually depreciating. It's actually the land value that's appreciating. So until you sell the property in a few years, right, 5, 10, 15, 30 years from now, you can actually depreciate the value of the property, the value of the building will go down, and you write that off as a depreciation. You get a tax benefit today. Now, it's not free kind of money right now, but as they say, just as they say, because of inflation, $1 today is worth more than $1 tomorrow, right? Put it in simple terms, you know, a loaf of bread, you know, could cost you $3 today, but you know, 20 years ago may have cost $2, right? And the reason is that because of inflation. So if we can get a tax benefit today, and then not have to pay that tax back for many years until you sell that property, you can do more with that tax benefit, right? So that's another stream of income today, right? And as a side note to that, the taxes that you pay on selling an investment property, you do have to pay taxes because it's not your principal residence, is actually a capital gains tax. Capital gains. That's an S, not a J. Capital gains. And the way that capital gains works is that you're actually only taxed at 50% of 50% of the gain. So let's just say, again, keeping everything nice and simple. I'm running out of space here. Let's just say that you made $100,000 in the gain, right? And let's also assume that you're in the highest tax bracket, and we'll just call that tax bracket 50% to keep it nice and easy, right? So that means that if you made $100,000, you're only taxed at 50% of it, right? So that's $50,000 that's taxable income, and you're in the highest tax bracket, so 50% of $50,000 is $25,000. So this is significantly better. It's basically only 25% taxes on $100,000 versus if it were income tax and you were in the highest tax bracket, you would pay $50,000, which is 50% of $100,000, right? So, the taxes can, with respect to investment real estate, can really work in your favor. All right. So let's keep in mind here. I know this is kind of a little bit convoluted here. I got my board exploded with drawings and such, but with investment real estate, we've got 4 streams of income in appreciation, positive cash flow, mortgage pay down, and a tax benefit. So I'll, in another video, I'm going to break down how that ended up working out for Lisa and I with our townhouse that we purchased in Milton, Ontario, just over 2 years ago now. And I'll break all those numbers down and give you an idea of how that played out. All right. So looking forward to seeing you in the next video. Thanks.